Welcome, everybody. Thanks a lot, Jason, for organizing all of this. Welcome to the FRTB Playbook, from regulation to go live. And frankly speaking, we are from regulation to go live now for 13 years. I just returned from an industry event, just took off my tie because that obviously is not very helpful for the credibility as a quant. And this evening, we want to go over the key features of the FRTB regime, but also where we are with its adoption and why it is so horribly complicated to actually get to live with this regime. And that is probably something which many of us are asking ourselves. And the other question is obviously, should it go live the way it is? Although that is only partly in our gift. Right. This is also an overview, not both of the regime and also of the class, which we are going to run in February and March, a masterclass over a time frame of 4 weeks, which you hopefully will find interesting. A few words on myself. My name is Thomas Obitz. I am a risk management and regulatory advisor. I'm helping basically banks to adopt new regulations as they come along, adjust their process and their models, working partly as a quant, partly as a program manager and advisor. In the context of FRTB, I have published a couple of papers which might be quite interesting for you about the link between operating model and models, about the FRTB NMF regime, which was actually one of the inputs for the revision of the regime in 2019, and then the interaction between the models and the output flow, the market risk models and the output flow. There was a paper actually this week again in Risk Magazine, which I wrote together with Eduardo Epperlein from Nomura about the NMF regime, which we also will have a quick look at later today. All right, without further ado, about this, the FRTB playbook. As I said, today we'll have a look at the regime at a high level. We'll walk through the rules, the Basel rules, not necessarily each of the national adoptions. That's certainly not feasible in an hour, and the various aspects of it. But also then when we are what I'm trying to do now, and certainly much more than in the actual class, is to discuss what the regulation is trying to achieve and why it is sometimes a little bit difficult to actually make it work in practice. How you get what we are trying to do in the now and also in the masterclass, then in much more, is to get to understand the link between the technicalities of the model, the requirements in terms of process changes, and the interaction of that with the top of the house capital impact, both at the level of the of market risk and then at the level of the overall of the overall bank. So this is basically a class which is meant to give an overview for everybody. So if you have a quantitative background, then you will certainly see how the calculations work, not necessarily at the level of thinking you need to invest if you are implementing the model inside the bank, because then you need to think about additional topics such as where do I get the data from, how do I clean the data, and all of that stuff. but also change managers who want to understand the process and the model interactions and what actually needs to be done holistically in the bank, how to adjust that. The IT team is implementing or integrating the models or getting the data right. Everybody overseeing these functions. So in recent classes I had many people from internal audit and from regulators and everybody else who is interested in these topics, which actually are quite interesting, at least in my opinion. Otherwise, I would not have survived the last 13 years. So what has happened? Well, in 2008, the financial markets pretty much broke down. And in the UK, it started here in the UK with Northern Rock. And then the culmination of this crisis was then Lehman Brothers in the US. That was not the first financial crisis and not the first time when actually banks went belly up and made headlines. But it was unprecedented in scale. So if you're looking at the history, Barings was one of the first large bankruptcies. And this was a very, very traditional bank, more than 200 years old. And a trader in Singapore who was actually supposed to do some hedging business took huge positions, and that was not that great when they went the wrong direction. However, when that all went the wrong way, well, this bank went down, but not that much else happened. In the end, it was sold to ING for £1. All right. Then LTCM happened as one of the next large events, and that was one of the first big hedge funds. So funds which took long and short positions, and you can't really claim that the people who were involved should not know what they were doing, given that the Schultz of the Black-Scholes model and the Black-Scholes-Merton model, as we usually call it. So both Schultz and Mertens were on board as partners. Mary from Solomon and former vice chair of the Fed. Nevertheless, that went the wrong way, and this time it wasn't done with one bank going bankrupt. The Fed had to arrange a bailout. Interestingly, however, the bets of LTCM went wrong. They just didn't have enough capital to back them, and in the end, actually, all of those banks which invested into the bailout were fully paid back. Yeah, and then Lehman Brothers. This time, Lehman Brothers was one of the mega banks at the center of the financial system, both long and short of derivatives. All of that had to be unwound. When suddenly Lehman Brothers did not have the liquidity anymore to fulfill its obligations. That is certainly a very, very unfortunate event. But interestingly, despite all of these cries of politicians that such things may never happen again, and that it was so horrible that the taxpayer had to bail out banks. But in the end, actually, the American taxpayer got his money back in full. But nevertheless, what has happened with Lehman Brothers is actually symptomatic for financial crisis to some extent, and it is a matter also of risk appetite in society. Obviously, nobody raised in this discussion in Congress that it was the American executive who actually encouraged everybody to buy his own house, regardless of whether he could afford it or not, and who pressed actually the banks to take on risks which maybe were not that well supported by collateral, by the income of those people who took these mortgages. The Big Short, many of you may have seen the movie. It's quite pointed on these topics. And in the end, what we have lost in the after the crisis, actually, with all of this bank bashing, all of us who are engaged in risk management know there's a tail, and this tail is, well, at least if you're assuming normal distributions, pretty much infinite. Not a very high probability that you have extremely high losses, but nevertheless, they're happening, and they are happening definitely more frequently than if you assume a normal distribution. And it is effectively a social and political decision where we are putting the trade-off between the risk of crisis and the cost of loans, because every pound of capital which we are putting behind a loan as a loss buffer, obviously, on the other hand, needs to be funded and needs to be paid for out of, well, first of the profits of the bank, but in the end out of fees and out of revenues which the bank is making. And that is obviously the discussion which we are having right now, whether actually we currently have the right balance between the stability of the financial system and the loss aversion, and the cost of credit and the economic growth in the economy. Good. Having said that, let's park these more fundamental comments. But one thing was fairly clear: banks had modeled their risks, and they used a measure called value at risk, which is basically an upper bound for losses at a certain confidence interval. So in a maximum of 1 out of 100 days, you would lose more than an amount X. And unfortunately, you had sometimes 10 days in a row where you lost more than these numbers, and you had several events which should not happen more than 1 in a million years. And that clearly showed that there is something seriously wrong with the risk management system and with the way the risk models were constructed. And one thing which nobody really thought about was that, well, under normal market conditions, yes, you can get out of a position which is making losses, and that is the standard way of liquidating it at some point with a stop loss or whatever. But if suddenly the market is gone, if nobody wants to buy certain assets, and that happened to the credit derivatives at that time, then you suddenly have a problem, and prices keep falling. And you definitely cannot get rid out of complex positions within 10 days. So these assumptions obviously didn't quite work. So then you had an assumption that actually the past is pretty much like that future is pretty much like the past, which is on the one hand certainly a key tenet of time series modeling and forecasting, but which in reality might not quite work that well. In particular, if you have market shocks and suddenly the volatility, that means the movements of your prices, is going through the roof in a very short time. And there is very, very clear evidence that this is actually what is happening in the market quite frequently. There is suddenly people realize that certain things do not work right. In particular, banks were considered safe borrowers, and banks could never go bankrupt. Well, with Lehman and with Northern Rock, obviously, we realized that this didn't quite work that way. And not only that, it was not. It was also that the accounting adjustments which you had to do for the credit risk of loss of your counterparty on derivatives positions, the so-called CVA, the counterparty valuation adjustment, that suddenly moved up and added to your losses, even without a default of your counterparty. So a lot of stuff which work together in order to move the markets in a way which nobody thought would be possible. And then immediately after, I mentioned, obviously, the politicians were up in arms, and something had to happen, and something had to happen really, really quickly. And then there was a tactical response, basically, to the crisis, which was what we then dubbed Basel 2.5. That basically meant that the capital which banks had to put behind their positions was suddenly not calculated just on the last year or 2 years, which may have been quite benign, but actually you had to go back into a period of stress, of market stress, and find basically how bad it can be under this in this period. And that then this introduction of the so-called stress VAR, which actually is between a factor 2 and 4 of the current VAR, together with the current VAR, which you still had to capitalize, increased then the capital buffers of banks very, very quickly by a factor of 3 to 5. So the risk measurement the capitalization became much less cyclical. You had to capitalize credit risk on a trading book. There were penalties on complex products and generally reduction of the incentives to shift things between regulatory regimes, regulatory arbitrage. So the incremental risk charge, the comprehensive risk measure. At the same time, however, the Basel Committee, so the Association of the Securities Market Supervisors, they sat back and asked themselves the question, what's going wrong here? And what do we need to do? And then several studies were performed, and one of the most influential ones was probably the 2009 study, the Working Papers 19, on messages from the academic literature on risk management in the trading book, where suddenly somebody actually looked at what research and what academia had written about how to manage risk and what maybe could be wrong with the existing risk management system. And out of that came this fundamental review of the trading book, the FRTB, which went through several consultations. The first one I had been involved with was in 2012 or 2013. Then in 2016, the final rules were published, which were clearly unworkable, and so in some areas, and so 2019, the final rules came out, which now regulators around the world are implementing or not. And we look into that in a minute. For those who are in risk management, you will be fully aware of that. For those who are not, when I'm talking about standardized approaches, that's basically a way of roughly estimating the risk of your positions and putting aside capital for that. Typically, these standardized approaches are quite broad brush, and therefore they're typically calibrated in a way that they are rather overestimating the capital by quite a bit. The Basel II standardized approaches are notorious for that. The internal models are more sophisticated. Complex models, statistical models like value at risk or now expected shortfall. So they basically look at the past behavior of the market and try to predict the riskiness of the portfolio. Now, obviously, that these models are complex and they contain model risk, and therefore the regulator needs to approve them. There's quite a high hurdle, and with FRTB, this hurdle has definitely been increased and made higher. They are subject to a capital floor. That means if you are just adding up all of your exposures under internal models where you have permission and standardized approaches where you don't have permission, and then compare that against the capitalizing everything under standardized approaches, then you must have at least 72% of the standardized capital. So you cannot save more than 27.5%, which is actually one of the adoption hurdles. Now let's look at what have we actually done with FRTB. What are the big changes? Well, let's start with the standardized approach. One of the biggest problems of regulators was that you could not compare that the numbers out of the standardized approach were so broad that you couldn't really compare them against the outcomes of the internal models for market risk and the Basel 2.5, and or they were not risk sensitive enough, right? And so that basically meant that nobody was really interested in these numbers if a bank had IMA approval. That also meant that banks which did have IMA approval typically did not even calculate these standardized approaches, and so the comparison wasn't there anyway. So now the standardized approach has been made much more risk sensitive. That means it's a much better risk for the actual riskiness of your portfolio. The bank needs to report the standardized approach numbers in parallel to their IMA numbers in the quarterly reporting. That's important also for the calculation of the capital floor. And the risk sensitivities are basically, well, they are you do not need to have all of this apparatus of time series behind, but they are calibrated in a way that they are roughly equivalent to what you would observe in the market. On the internal model approach side, you have now an expected shortfall model replacing the value at risk. So expected shortfall has a couple of features which are desirable. Specifically, it is sub-additive. That means if you have two desks and you combine the portfolio, you will always you will not end up with a larger risk than if you're just adding up the numbers of these two desks. That can happen actually with VAR, although the cases in which that happens are a little bit atypical. This assumption that you can sell everything within 10 days, that also didn't work, as we have seen in financial crisis, and therefore their liquidity horizons are much better aligned with the market. The calibration of the model is under stress. That means you are trying to basically estimate what can happen in a worst case crisis. Penalties for if you have factors in your model which you do not have enough data to really figure out how they are moving, what is the correlation with other risk factors, and so on. That's in a fairly punitive regime called non-modelable risk factors, NMIFs. There are constraints to hedging and diversification benefits. And there's a default risk charge similar to the incremental risk charge on Basel 2.5. However, the double counting of credit migration risk has been removed. And the third component of the framework is basically to get in tighter control and less subjectivities of regulators when they're looking at the capital demand of a bank. So the IMA approval, yes, you still need an approval at the bank level, and you need to fulfill very similar requirements as you need to fulfill under Basel 2.5. But in addition, you also need to demonstrate that the model is actually workable at the level of each individual trading desk. And the means for that is a back testing at desk level. That means if you are calculating, for example, a value at risk as a measure which is still used for the back testing purposes, and that value at risk measure says you should not have more than 2.5 outliers in a year at a 99% VAR. And you have 20, then the regulator will not look at that in a very kind way. And this desk will follow the modelability. The bigger hurdle is actually something called the P&L attribution test, and we can't go into that in detail now. But it will be a very interesting topic in the masterclass, how you actually can address where these challenges come from. So P&L attribution test means that you have to compare the P&L which you're producing with your risk models against that which the front office is producing. Obviously, that is... They traditionally had quite different models, much simplified models, often in risk. And so this was not always in line. Data sources were different and additional things. So there are quite a few things you can stumble across, you can fall over, and this is actually at the moment the biggest hurdle for banks to adopt IMA. To actually pass this test. So 80% of the desks are apparently still failing. And tighter rules, controls, and supervision of the trading book, banking book boundary. That was the regulatory arbitrage, which I mentioned at the beginning. What the carrot which some regulators keep dangling in front of the banks is that some capital charges which are currently sitting in Pillar 2, so additional charges which the regulator are imposing for uncovered risks, that they might actually migrate into Pillar 1 and be covered by the FRTB framework. We'll see some regulators came up with concepts like risk not in model engine in Europe, and there's still a concept of risk not in VAR or not in model on him in the UK. So let's see what happens there. Good. I already mentioned there are two approaches, the internal model approach and the standardized approach under FRTB. At the moment, 10 banks have declared that they are planning to adopt the internal model approach. As a comparator, I just by chance have the numbers for Germany because I was working there. Before the financial crisis, 52 banks had internal model approval. So that is compared to 10 banks globally. That is a little bit interesting, and the regulators are clearly not happy with that. It is a problem for them as well, because they're losing a lot of communication with the bank if they do not have IMA approval. Standardized approach has been improved quite a bit. There's going to be a simplified standardized approach, and what that means is basically that the banks are permitted to continue using their Basel II standardized models. This is for small banks where it simply doesn't make any sense to do big model adoption and get out of the market data and calculations in place. You can't use it once you're above a certain threshold. Now let's look at the models themselves, and both of the internal model approach and the standardized approach have 3 components each. So I already mentioned the expected shortfall. That's basically the capital which you need in order to back your day-to-day market variability. That's now calculated by this expected shortfall measure. So you're trying to estimate how much you are going to lose if you have a large loss of more than, in that case, 97.5% confidence level. Then so that's the direct replacement for the VAR, and also produce actually quite similar numbers. The second part is the non-modelable risk factor charge for those risk factors, as I mentioned before, where you do not have enough data to back them. And then the default risk charge, which is replacing the incremental risk charge. That's basically if today a default of my counterparty happens, how much will I lose immediately from that? And the reason why you need that is that actually there is an information asymmetry between the management of the firm and the market. So you do not know that tomorrow a bank will a bank or an industry company whose bond you are holding might be bankrupt, right? As an event risk. And yes, you will have some indication that something is wrong, and that therefore also your market price is going down of that bond, for example, to price in the increased credit risk, and that is what we are covering in the expected shortfall charge here in the credit risk, in the credit spread risk, but there will be still a substantial loss the moment the default happens. Similarly, on the standardized approach, you have the sensitivity-based approach, and that is effectively a parametric value at risk or parametric expected shortfall, completely equivalent. If you in that regime, and that's just calibrated in a way with stylized risk weights and correlations. So basically, the regulator gives you 4 banks. You have this kind of riskiness, which you then multiply with your position size, aggregate that with regulatory given correlation. So you do not need to do all of the number crunching, which you need to do in order to calibrate an expected shortfall model. For those risk factors which are actually not covered in the Sensi-based approach, you get a residual risk add-on, which is fixed fixed percentage of your position size, from 1% for exotic underlying, 0 to 1% for other residual risks, and back-to-back transactions are excluded. Okay. And then there's a standardized version of the default risk charge. All right. So far, things have been very, very mixed in terms of adopting this FRTB regime, because in the end, the Basel Committee is an association of security supervisors, but that obviously needs to be translated into national legislation and national rules. What you see is actually that almost that most of Asia, the trading centers in Asia are live. So Hong Kong is live, Japan is live, Singapore is live, China is live, and several other countries down there. South Africa went live, Saudi Arabia, and Canada, Switzerland are live. The Europe and the UK have near final rules, and they have partially rolled out Basel III, but neither the UK nor Europe have the market risk rules in place yet. So Europe is basically on the Basel III regime for credit and counterparty credit risk. And uses the old value at risk Basel 2.5 rules for market risk still. That is expected to be to change either in 2027 or 2028 in both countries. The reason why this has been delayed for such a long time is that basically the European regulators and the UK are concerned that the rules, the impact of the rules might tilt the playing field in case the US is not going to adopt FRTB, which currently still seems unlikely, but there have been massive campaigns against this regime in the US in public, both on the credit and on the market risk side. And clearly there is at the moment, what we hear from out of the Fed is there will be. What has happened was there were draft rules back in 2014, in 2023, 2014, but those have been withdrawn after the election of President Trump. And now we are the regulation vice chair of the Fed stepped down in February, and Mikhail Bowman, who is replacing him, we do not quite know what is going to happen. We do know the people from the Fed basically give the indications that that rules are to be expected towards the end of the first quarter next year. Let's see whether it really happens. All right. Those banks who are trying, so the situation at the moment is in Europe, all banks are reporting standardized approach. But the capital is still calculated on Basel 2.5 rules, as I said. The other thing is there's only one single bank in the world which is actually live with an internal model permission for FRTB, and that's Nomura in Japan. So 10 banks, all in all, last year have uttered in an ISDA survey that they are planning to adopt the internal model approach. We know of two banks in the UK which went on record, three banks in Europe, one in Singapore. So that is all a bit less than the regulator expected. All right. The key issues which banks are facing with the new regime is the capital impact. On the one hand, and that is not only the level of capital, it's also the variability of capital, because you can actually lose your permission to report a desk under IMA if you're failing this famous or infamous P&L attribution test. So this variability of capital, because demand and and why similar compute demand for this ES model, the way it is constructed, is about 30 times higher than that of Basel 2.5 models. By the way, because of the way this model is constructed, and that's a serious problem, obviously. Nobody really likes that situation. And that means, for example, that almost all banks have moved away from internal model from Monte Carlo simulation to a historical value at risk or a historical expected shortfall, which is pretty counterintuitive, given that the whole idea was to better understand the tail of the loss distribution. Struggling with the case of since the in under IMA savings are much higher than expected.
Hello, Tom.
Yep.
Sorry to interrupt. I'm not sure you've got what the internet connection is like there, but you seem to be cutting in and out slightly.
That is seriously bad.
Just last few minutes, it's just dropped out a couple of times.
Let me see. Okay. More than 1 gigabyte downstream, with upstream. And afraid. Wait a moment. Let me just see whether.
I think it seems to have stabilized again now.
Okay.
It was just cutting in and out, but now it's stopped doing that. So I don't know what that was, but maybe it's going to be okay now.
Okay, I was just checking whether the microphone is all right, but it seems to be all right.
Yeah.
Good. Coming back to the class, we will have basically a lot of discussion, certainly, around what we're doing there, and so we're trying to engage everybody, and there will be there will be very practical examples for doing the FRTB capital calculations. For example, we are going to discuss in detail what is actually the capital impact. At the end of the class, you will have a test, basically, just for your understanding, and you will get a certificate. Good. That is effectively the Basel regime in how many? 7 slides. Obviously, the remaining 100 slides, which I currently have, and the 400 slides for the actual class, that goes a bit deeper, but you already have an overview now. So we will look at why are we setting risk? Why do we need to set up risk management in firms? What is the history of financial crisis? How is the adoption going? And what are the obstacles? What is actually the capital impact? And why are these? Why it is important actually at the level of each business to be profitable? Why does the capital impact on the trading business count more in this context than the 2 or 3% top of the house impact? Geographical differences in adoption. Why do different regulators actually? Why this discussion about internal models? This is the benefit case. Actually, this is actually the outcome of Nomura. You see actually that we cannot go into all of the details, obviously, of calculations today, but what we are going to look at is the way internal models are working. They are structured, how shocks are applied to generate market scenarios, and differences between value at risk and expected shortfall, how to calculate that in a practical scenario with historical simulation, partial expected shortfall. What does this period of stress mean? The liquidity horizon mapping, and why is it all of that so hard to calculate? So the compute demand of FRTB models is higher compared to the Basel 2.5 models by a factor of about 30, which means that almost all banks have dropped Monte Carlo simulation. I'm only aware at this stage of one bank which is trying to run IMA on Monte Carlo. So that is an interesting topic in particular, because one of the objectives was to better understand the tail of the distributions. Default risk charge for internal models, we briefly discussed that in the beginning. I won't go deeper into that. And then obviously, how is the capital aggregated? How do we put all of these pieces for these 6 components, 3 from internal and 3 from the standardized approaches together to arrive at a capital figure? What is risk factor modelability, and how do I calculate capital for non-model risk factors? What does it mean if a risk factor becomes non-modelable? What can I do about that problem of NMIFs? The regulatory aspects, what do I need to do to get internal model permission under FRTB? The famous P&L attribution test. What drives these discrepancies in the PLAT, and what can I do about it? We will have a look at the CVA regime. There we probably won't do any practical examples because that's very technical and requires quite a bit of compute power. But we will also have a session which is simply about the organizational impact. What does it mean for your desk structure, for the business strategy? What are desk structure constructs which are likely to change under the FRTB regime? What can go wrong? The famous trading book bounding, banking book boundary, how do you manage that? Specific constructs for desks which you need in order to get internal risk transfers recognized between the trading book and the banking book. And then whom do you need to get on board in order to get this new market risk framework in place? What does it mean for your data flows, for your system landscape? Decisions on using cloud, approximation, what new BI do you need? And then also, for model validation, for internal audit, that's really important. There's an enormous amount of work to be done in order to get FRTB over the line. Finally, a couple of general notes about what are ways of structuring a regulatory project. How do you create tractability both between what you're changing and the regulation, and also how do you actually document the decision which you're taking on the in the process? How do you ensure that you have some documentation which you can show to the regulator afterwards if they ask you why have you done it this way? Most banks obviously are deep in their implementation, mostly on the standardized approach, because that is something they're already reporting, at least in Europe and the UK. But how you are setting up the project is changing the front office, because it now starts becoming visible in the capital figures. The front office is much more interested. They often claim the driver's seat from risk. You also need to keep finance in the loop, but I have only seen once that a bank was trying to put finance in the driver's seat from a capital management perspective. That can be challenging. The reasons why also the regulators are quite interested in getting banks to adopt internal models, and when you're trying to adopt internal models, what are the typical issues? Getting a permission, what do you need to look into? And then certainly the big question, is all of that going to make the financial system more stable, more reliable? We should have a conversation about that as well. All right. We'll have the class starting on the 24th of February for 4 weeks. We will end with an assessment and a certificate. We will have practical labs with calculations of the standardized approach, IMA calculations, in particular, obviously, the expected shortfall calculations, and then the capital aggregation. You will see that Python is a very, very useful tool for this kind of calculations, and that is actually probably easier to read than an Excel sheet. You do not have to be, as I mentioned before, you do not have to be an Excel wizard in order to take part in the class. Okay, apologies for the inconvenience. So I will not go into the screen share again in case it's linked to that. But what we will do in the class is certainly to run the calculations in practice. That means we have small sample portfolios on which we are going to calculate a standardized approach, the IMA, the capital aggregation, and so that you get a feeling for how that works. We will do some of the calculations certainly in Excel, like the capital aggregation, but we will also use Python notebooks, Jupyter notebooks, which you can also download afterwards after class. There will be an online forum with discussions in the subsequent session. After each of the after the class, there will be a multiple choice exam and a certificate, and the participants will have access to the class for 12 months after that. One important thing is, yes, it would be helpful to have a basic understanding of market risk concepts and the financial instruments, basic statistics, but we do not expect you to be a Python wizard. So yes, we're using Python there, but we'll explain what the code is doing. We're explaining how the commands are working, and if it is something which is a bit more complex in Python, like for example when we're using matrix operations in order to do P&L calculations, we will explain how that works in detail. You do not need to install Python on your machine, but you will need a GitHub account, because you will get the code will be on GitHub, and most likely we are going to use Google Colab for the calculations, or AWS. We are not quite sure about that yet, but you will get instruction up front for how to do these calculations. For the Excel examples, Office 365 is obviously the most recent version, and there we know it works, but we are not doing anything which should not work in any other older versions of the of Office. In case there are any questions coming through from LinkedIn, Jason, do let me know, and I will try to answer those. I haven't seen anything yet. The national implementations. Okay, so we will have a look at the way the different regulators are modifying the regime. Obviously, this is a 16-hour class. We can't go through every single national implementation. However, I personally have been working on three regulatory regimes so far, and had direct exposure to that. So I can give you an idea of how the different regulators are approaching this, and why the texts which you see from different regulators for the Basel rules are looking quite different. Then, thank you very much for everybody for attending the class and this talk. I hope you found it useful to get an overview of the FRTB regime, and and also of the class which we are going to run. Thanks again, and hopefully see you in February.